2025 could mark the beginning of potentially the worst investment period in recent years. That's the key message from a recent Goldman Sachs report, which has made waves by suggesting the stock market might only deliver total returns of 3% a year over the next 10 years. That would definitely feel disappointing compared to the 13% annual returns we've grown used to over the past decade, and the long-term average of 11% a year. In fact, the 3% return might barely outpace inflation, meaning investors could see very little, if any, real growth in their money. Now, let me give you a scenario. This is Ben. He's someone who constantly checks the news for the latest updates about investing and the stock market. He listens to financial commentary, subscribes to newsletters from big firms, and reads every market insight he can find. But after reading this Goldman Sachs report, Ben decides that's it. The worst investment period just started. I'm done investing. He might even text his friends saying, I stopped investing once I learned this. Check it out. So in this video, I'll walk you through the key points of the report and explore whether Ben is making the right decision to stop investing after hearing this prediction. Believe it or not, plenty of new investors go through this thought process and sell their investments every time they come across predictions like this. But is this really something to be worried about? Let's find out. First off, Goldman Sachs points out that stock market valuations are way too high right now, which suggests that future returns could be much lower than what we've seen in the past. Goldman Sachs bases this statement on this key chart that shows the S&P 500's price-to-earnings ratio from 1930 to today. So almost 100 years of data. In simple terms, the higher the number on this chart, the more investors are paying for a company's future earnings. A higher number means stocks are expensive, while a lower number means they're cheaper. Goldman Sachs is saying that if you buy stocks when they're expensive, it's going to be harder to make a profit in the years that follow. Honestly, I don't think anyone should be shocked by this. It's clear that the US stock market is much more expensive now compared to other markets worldwide and compared to where it was decades ago. There is also a lot of evidence showing that investing when the market is high tends to lead to lower returns in the long run. Take a look at these graphs from JP Morgan's most recent quarterly report. On the left, we have expected 1-year returns, and on the right, expected 5-year returns, both based on the current PE ratio of the S&P 500. Just for clarity, the PE ratio is just a way to measure how expensive a stock market is compared to its earnings. The key point here is the red square on each graph. This shows the average return that was achieved in the past based on those PE ratios. As you can see, the higher the PE ratio, the lower the future returns tend to be. In the short term, returns can be volatile, but over the next 5 years, higher PE ratios generally lead to lower returns. This might seem like a no-brainer. Stocks are too expensive, so we should all just stop buying them and change the way we invest. But is it really that simple? I'll come back to this point in just a bit. But let's move on to the second point they make. The stock market is more concentrated than it's been in 100 years. They argue that based on their research, it's really tough for any company to keep growing sales and profits at high levels for a long time. According to them, only 3% of companies have managed to grow sales by 20% or more each year for a decade. And just 1% of companies have been able to maintain profit margins above 50% over that same period. In other words, when a company does really well for a few years, it's much harder to keep that momentum going. Now, a large part of the market depends on just a few major names, like Nvidia and the other Magnificent Seven. And this has Goldman Sachs worried, because if these companies don't keep growing, the entire market could suffer. As you can see from the chart they've shared, the market cap of the largest stock compared to the 75th percentile stock is almost at an all-time high, and the weight of the top 10 stocks on the S&P 500 is also showing the same trend. This data definitely looks pretty concerning, and I'm sure any new investor might think it's not the best time to invest, especially when comparing it to the past. However, before we move on, let me share my thoughts. First off, let's circle back to the first point about valuations. Here is how I see things, though I could be wrong. While valuations do matter and the PE ratio can be a helpful guide in the long term, we are not comparing the same kinds of companies. Over time, the companies in the index have changed completely, and the world looks nothing like it did just a few decades decades ago. Think about it. Imagine one version of the S&P 500 was made up of slow-growing, established companies. Then compare that to another S&P 500 where all the companies are fast-growing tech giants. Just based on that alone, you would have to agree that the second version should have a higher PE ratio because of its growth potential and future prospects. Well, this is essentially the situation we have today, where the S&P 500 of today looks almost unrecognizable from just a few decades ago. Technology has really changed everything. And while some people got carried away during the dot-com boom, I'm sure you'd agree that today's tech giants are much higher quality companies that are delivering more profits than ever before. It's really hard to compare the stock market today to the past because things are so different now. We are looking at more established businesses with much more solid earnings potential. Also, when it comes to the second point they make about market concentration, it's worth pointing out that market concentration alone is a less effective indicator of investment outcomes than valuation. Sure, since 1930, the US market has almost never been this concentrated. But yet again, we're talking about completely different circumstances. While high market concentration, where a few large companies dominate the index, can be concerning, it doesn't necessarily mean poor returns if those leading companies continue to perform well. If they keep growing and delivering strong results, the market could continue to do well, despite the concentration. One thing I do agree with is that since the S&P 500 is pricey and very concentrated, it means there is a lot of risk tied to the tech sector, which is what causes this overvaluation and concentration. If the tech sector, especially the AI boom, doesn't pan out as expected, the whole index could take a hit. But personally, I think it's highly unlikely that this sector will ever stop being the dominant one. However, here is the good news. If you look beyond the S&P 500, especially at other parts of the US stock market, and even more so at international markets, both valuation and concentration are much less of a concern. Goldman Sachs does make some other points about why they think returns will shrink. For example, they say the economy will contract more often over the next decade. They predict that the US will see 4 GDP contractions during this period, which means about 10% of all quarters ahead. From there, they claim this will typically lead to lower stock market returns. But here is the thing, we really can't know what's going to happen with GDP. So basing stock market predictions on this kind of economic guesswork doesn't hold much weight in my opinion. If it was this easy to predict things like this with certainty, we'd be living in a very different world. I think this argument about GDP is one of the weaker points in the report, because it's incredibly difficult to predict the future based on past patterns, especially when it comes to something like GDP. They also argue that corporate profitability is likely to slow down in the coming years. In simple terms, if profit expectations drop, stock prices could follow, because the price of a stock is essentially the expected future returns of that company. While that's a fair point, it assumes that all businesses will struggle equally, which isn't necessarily true. Many companies have already adapted to inflation and rising costs through automation and efficiency improvements, helping them maintain their margins. Take Apple, for example. Even with the current economic challenges, Apple has managed to keep strong margins thanks to its pricing power and customer loyalty. So while profitability might decrease for some companies, others are in a strong position to grow, even in tough times. There is no way to know what the stock market will return next year or over the next decade. It's all just a guess, and honestly, I think it's a waste of time and resources trying to predict it, because 9 times out of 10, these predictions turn out to be wrong. Now, going back to Ben's decision to stop investing after reading the Goldman Sachs report, Ben's decision to sell is a classic example of reacting to market noise. It highlights once again how financial media can cause investors to make poor long-term decisions driven by fear. Because ultimately, Ben's decision is based on fear. Fear of missing out on better returns elsewhere, or fear of losing money if the market doesn't perform as expected. In reality, the true path to wealth is ignoring these short-term distractions and staying focused on the long-term growth potential of the companies in which you've invested. By selling, Ben might lock in losses or miss out on the long-term gains that come with staying invested. But if instead he takes a step back, ignores the noise, and remains committed to a consistent long-term strategy, he could fare much better. Personally, I'm going to ignore all predictions about future stock market returns, keep investing regularly, and focus on the long term. Even if stock market returns are lower in the next decade, one simple way we can make up for it is by increasing how much we invest, because higher contributions can help compensate for lower returns over time. Also, if you think Goldman Sachs might be right and returns could be lower, diversifying globally could be a good option. A global fund typically has over 60% of its investments in the US anyway, so you wouldn't miss out on growth there. But you'd also be positioned to benefit from growth in other markets around the world. Now, if you're not sure whether to stick with an S&P 500 index fund or go global, check out this video to see which one might help you build wealth faster.